This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by Smartbooks, provider of bookkeeping and accounting for businesses. Let's get started. So I'm joined again here by Greg Reed, head of tax at Smartbooks, and we are recording this toward the end of September 2025. So we're approaching year end, and there are always some tax considerations to worry about as we approach year end. So Greg, what should people be thinking about? What should they be asking their CPA about?
Yeah, this is an exciting year. As far as tax planning and tax law changes go, we've got the Big Beautiful Bill Act coming into play. Certain factors of that are phasing in between this year and next year, and so there's a lot of planning opportunities, a lot of things that you'll want to talk to your CPA about. And how they apply to your specific situation, things to be thinking about for long term. So yeah, there's a lot to go through here. The bill itself is 400 pages long. So I think we're just going to focus on a few things for business owners, but there's a lot of meat here.
Well, where do you want to start?
So I think we'll kind of start with the more basic stuff and then kind of move down the list to some of the more complex stuff that you'll definitely want to bring to your CPA and talk to, and maybe long-term planning. And so the first one for business owners is 100% bonus depreciation is back. And this is a huge thing for business owners who especially are maybe operating around like a break even or a loss, that are buying new equipment, vehicles, stuff like that. And the benefit of bonus depreciation is that you can put yourself into a loss situation. Whereas Section 179, which is the other accelerated depreciation method, that you can only go down to zero and then anything else carries over. Section 179 is definitely more for small businesses. I think a lot of your listeners probably don't run up against the Section 179 limits, but if you're a bigger business and you're buying lots of equipment throughout the year, in excess of $4 million, then Section 179 might start phasing out.
Okay, so we get the bonus depreciation for folks who buy assets, and if it puts you into a loss, it's still like I'm always heard you cannot go below your basis in an S corp or an LLC or something, but
so you might run into basis issues. So there's all these factors that you have to bring into play to see if it makes sense for you. The good thing about bonus in 179 is you can make the election when you file the return. And so you can kind of see where you're at and say, okay, you know what, 179 makes more sense, or maybe it doesn't make sense to take accelerated depreciation at all. Let those assets, depreciate over 5, 10, 5, 7, 10 years, whatever. And, take that deduction over time.
So this is something you are able to wait until February, March and talk to you about.
Yeah, absolutely. Yeah. When I prepare returns, it's, do we take 179? Do we take bonus? Do we even need to? It's generally like, I know it's something that I'm thinking about. And I'm sure that, most good CPAs out there are. One thing to note about the bonus depreciation, and this is an interesting, I don't know what you'd call it, but basically it only, even though it's retroactive, it's only retroactive to January 20th when President Trump was sworn in for his second term. And so any pieces of equipment that you bought prior to January 20th, so that 20-day period is still subject to the 40% bonus depreciation limit. Also, anything that if you bought it under contract, but it wasn't delivered yet, even that wouldn't be subject to the 100% bonus. So if you bought something, say, a big piece of equipment, you put your down payment down, but then you didn't receive it until February. Unfortunately, that wouldn't qualify for 100% bonus. So the contracts do make a difference.
All right. So, what else, Greg, do we need to think about beyond the 100% bonus depreciation return?
So for those pass-through entities, we always had the qualified business income deduction, which is kind of that 20% deduction. I always equate it to uh, it's Congress putting the lower C corp tax rate and the pass-through businesses on the same playing field, right? So like they lowered the C corp tax rate to 21%. All these pass-through businesses were like, what the heck? I'm subject to potentially 37% at my individual tax rate. So they enacted this 20% qualified business income deduction, which in a way evens the playing field. That's going up to 23% starting in 2026. So not something you get for 2025, but something to think about for 2026.
So, it would seem like that benefit is here to stay, at least for the next
That
3 to 3.5 years, right?
So it was made permanent. Again, nothing's ever permanent, but technically it was made permanent.
And that's
So we
huge
will.
because I know when I do my tax returns, we're a pass-through entity at smartbooks, and it's always a bit of a mystery to me, this whole QBI deduction. It seems like it's a big benefit, but it's kind of a black box. So at least I know it's good for
Yeah,
probably another
it's
30 years or so.
it's here to stay. I honestly, I think it would be detrimental to Main Street America small businesses because most small businesses are pass through entities, and now if you don't get that 20% deduction, a lot of people will get buried.
Okay, cool. What else
Um,
do we need to be thinking about these days?
the so state and local tax SALT, um, that Schedule A deduction on your individual return was limited to $10,000 a year, and it was the aggregate of your um, state taxes, your personal property taxes, excise taxes on your vehicle. Um, if you went the sales tax route, then sales taxes that you paid. Basically, any taxes that you paid from a personal standpoint, that would get limited to $10,000. This really hurt people who live in high tax states. So if you're in California and your tax rate between um, federal and state is like 50%, and your property taxes are really high, basically your Schedule A went from your itemized deductions. So when I say Schedule A, I mean itemized deductions went from a giant number to a uh, very low number, and a lot of people just phased out of Schedule A, and it was just more beneficial to take the standard deduction. So, like when I first started working, or I guess pre 2018, most of my clients took had a Schedule A, and then after 2018, most of my clients don't have a Schedule A. Anyways, the 10,000 is going up to 40,000. Unfortunately, that is not here to stay. That's only here for a few years. We'll see what happens. I want to say it was like 2030. I might be wrong on that, but we'll see who's in office. We'll see, how things shake out. Maybe it'll get extended. Maybe it'll be made permanent. But for now, that 40,000 is here to stay. Now, that being said, a lot of these states who, a lot of people are moving from California to Texas, or, to these, Florida, these lower tax, no tax states. And a lot of the states started enacting this pass through entity tax. So for business owners, basically, you would get to pay your individual tax at the entity level. You take a deduction for that um, on your P&L on the business, and then you get to take a credit on your personal tax return. The government, or the IRS, or federal government, didn't love this, but they didn't really have much to. They didn't have much ways to get around that. And so that is actually, I think this is like one of those planning opportunities where you get to kind of look at both sides to see what is more beneficial. But I would say that for most successful business owners, which if you're thinking about the pass-through entity tax, I would say you're a successful business owner. Um, it still makes sense to do that. But you do have the 40,000. So if you're in a high tax state, high property taxes, you're probably still gonna be in that 40,000 area, and you still get to utilize the pass-through entity tax. So maybe it's a double whammy.
Yeah, well, I hope everybody who's listening is paying more than $40,000 because that means you have a nice high income and a nice big house.
Yes, yes. Um, the let's see. Oh, okay. So getting into some more niche or advanced tax savings opportunities. A lot of people may not even realize that this was happening, but um, back in 2021, the IRS said that, or Congress, I guess, said that you could no longer take your R&D expenses in the year that you incurred them. You had to take them over a 3-year period.
And this was a big deal for startups, especially venture
This
backed
was a big deal
startups.
for
Yeah.
startups, especially so pre-revenue startups. Yes, it's a big deal. It just meant that maybe your NOL got deferred a little bit, but where I ran into issues was the companies who were doing R&D, selling a product, maybe just like at break even after their R&D expenses, and all of a sudden now they have taxable income. It was
Because they
borderline
could not
unfair.
deduct all their R&D expense up front.
Yeah, exactly. So yeah, you'd have like the R&D credit, but at the end of the day, you'd have this giant add back on your tax return, and I would get a lot of questions of what is this? Uh, why do I show net income on my tax return, but uh, a loss on my financial statements? Um, and then everyone thought that I was a really bad tax preparer for a couple of minutes. Until I had to explain to them that unfortunately this is the law, and it is what it is. Well, now we can actually retroactively go back and either amend tax returns to take those expenses, or we can elect to take those expenses um, in 2025 or 2026. And so huge benefit and huge planning opportunity for businesses. Do we continue to depreciate or amortize those expenses, or um, do we take these expenses now? Do we go back and try to um, amend returns? There's a This is one of those situations where you're gonna have to kind of take a look at your very specific situation and see what makes the most sense.
So, for anybody who's incurred a large amount of research and development expense last couple of years, this year, next year, something to look really closely at to figure out how to optimize the tax situation.
Absolutely, yeah. I mean, I think as tax professionals, we all knew it was coming because it was so, in my opinion, and this is just my opinion, but it was like egregiously unfair. Um,
Right, you're spending a whole bunch of money, you're investing and hoping something works, but you cannot even deduct it now, right? You're
yeah,
taking a whole bunch of risk, you can't deduct it. Maybe it works out, maybe it doesn't. You may never get any tax benefit from it. So I can see where you're coming from. It doesn't seem particularly fair to the entrepreneur who's taking all that risk.
exactly. And so, and the whole point of the R&D credit is to promote research and development here in the US. So, um, unfortunate that it was something that got passed back in 2021. But I'm glad that it's been rectified at this point. Um,
Cool. Is there anything else significant, major that we need to think about going into your
so
end?
there's one that I just learned about today. Um, and I'm going to give you like the high level, Cliff Notes version, but it's such a good benefit that there's a lot of gotchas.
And Greg,
And
you're a
so,
certified tax coach, right, with the American Institute of Tax Preparers or something like that?
yes, I'm a certified tax coach.
So you
So
get like the inside scoop on all these developments as they happen and how to implement them for
this is
clients.
actually where I got it from. Yep. And so the benefit of being a certified tax coach and being part of this organization is that not only do I get the inside scoop, but I also get I also get a lot of cases that are basically, audit proof because, maybe they're clients who have already been audited by the IRS. Um, there's a lot of people in the organization who have clients that maybe have already done this. So we kind of get that protection in that way. Um, but between 2026 and 2031, if you if you build a building for manufacturing, so you have to manufacture, it can't be office space or um, it can't be like an Airbnb or anything like that. It has to be a commercial building for manufacturing. You can write off 100% of the purchase price.
That's huge because normally you have to write off buildings over like 35 years or something.
39 years.
39?
Yep.
Yeah.
And so this is, what's funny is like as I was going through this, I always tell clients, don't buy a building just for the tax benefit because chances are, unless you do a cost segregation study, you have to depreciate over 39 years. You get the land piece and whatever. Um, this wipes that comment out out completely because again, if you meet all the criteria and you can um, depreciate that over or you can take that deduction over um, in 1 year, that's massive.
So listen, everybody listening, if you manufacture anything at all, you got to talk to Greg. This is a huge tax benefit. This gets you, you have $1 million building, you deduct $1 million over the course of one or a few years versus 39 years.
Yeah, and so I think it's when you place the building in. So the building has to be placed into service before 2031, and you have to break ground, obviously, between 2026 and 2031. And so again, this is like all high level. I probably need to do a little bit more reading on it. But if I have some clients, they've got a lot of money, they don't know where to put it. Maybe some form of manufacturing building. Let's deep dive into what. So I guess manufacturing, production, and refining. And so like the webinar I was listening to, the guy was talking about a coffee bean roaster, which like didn't even dawn on me. But you're taking your product and you're refining it, and then you're
Right, so you're not talking about like smelting steel. I mean, you could be
yeah, no,
making
yeah, this
coffee,
doesn't have to
maybe.
be yeah, this doesn't have to be like Detroit where you're like building cars or something. You can, you know, roasting coffee.
Cool.
Um, yeah, so I thought that was really cool. I'm excited about that one. I can't wait to try to put that one into play with a client. Be fun to see that giant deduction. The other this one's not as exciting, and maybe I shouldn't have finished with this one, but the 1099 thresholds are going from $600 to $2,000.
To 1,000 or 2,000?
Two
Oh,
thousand.
okay. Well, that's nice. That saves people paperwork. It's just such a compliance headache to have to deal with. So
It really
it's
is,
nice to get some
and
relief there.
so it was 1954 that $600 was set into place. It was never adjusted for inflation. Had it been adjusted for inflation, we'd be looking at like a $7,000 threshold now. But I'll take two. That's for 2026 though. So unfortunately, when you're filing your 1099s in 2025 or in January of 26 for 25, you're still dealing with the $600 threshold.
All right. So, we're recording this in late October, and I hope you've all taken the opportunity to like schedule a tax planning meeting with your CPA as we go into year end. Last thing I ever want for any business owner is to get a surprise tax bill in March or April, and even worse, not have the cash to pay it. So I always encourage business owners work with their CPA. You can work with smartbooks, work with Greg, get a tax planning meeting on the calendar, figure out what your tax projection looks like and what moves you could take advantage of between now and the end of the year to get that tax bill down.
Yeah. Of course, I'd love to talk to as many people as I can. Um, but, if you already have someone you're working with, definitely get on their calendar, figure out, um, you know, A, like what your tax liability is going to be, and then B, how can you get it down? So there's tax projection and tax planning. These are two different things. Projection is this is what I'm going to owe in April. Planning is how do we get that number down? Um, other things to, one other thing to think about is now is the time to look at entity structure. Um, there are some professionals out there who are trying to make the case that, a C Corp is actually starting to look a little bit more beneficial for small business owners. I don't know if I disagree with them. I think it depends on everyone's kind of personal situation. But, if one of the questions you should be asking your CPA is, you know, how is my entity structure? Are we structured in like the most tax advantageous way, not for just this year, but for, the next 5 to 10 years?
Yeah, completely agree, Greg. So, if folks want to have a discussion with you to make sure they've optimized their tax situation, what's the best way for them to reach out to you?
Best way to reach out to me, you shoot me an email, greed, at smartbookstax.com. You can go to our website and book a meeting with me there. Um, and then, yeah, get on my calendar and, before year end, and we'll we'll help you out.
Awesome. So listeners, take advantage. Get on top of this tax train before it becomes too late. There's a lot you can do over the next 2 months or so, but you got to talk to somebody who knows what they're talking about, who can advise you to, take the steps you need to keep your tax bill down and avoid those unpleasant year-end tax surprises. Thank you, Greg.
Even if you're in a loss this year. Yeah.
All right. Well, this has been
Good
another
time to do
exciting
it.
episode of the Empowering Healthy Business podcast. See you all next time. Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage smartbooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.